Intelligent Investor, Chapter 1, is Video 2, which talks about investments versus speculation. An investment operation is one that is thoroughly analyzed intellectually, and there is some technique for doing that, which this book will share. It promises a safety of the initial principle of investment and provides adequate return, not excessive return, but adequate return. Everything else is speculation. At any given point in the market, there exists some sort of a speculative factor. There are a certain number of speculators always in the market. And when the market's at an all-time high, you could assume there are many more speculators than it is when it's an all-time low. And risk in terms of a stock is never really eliminated at any given point. It's simply transferred from the seller to the buyer. So at any given point when someone is buying, someone is selling. So that seller either needs money desperately or thinks that it's too risky to keep holding. Important learning here is to understand the difference between speculation and investment, and to keep the speculative account separate from your investment account. And also to realize that speculation is some sort of an instinct of gambling that pretty much all humans have. And the best way is to restrain it with less than 10% of your total wealth, keeping the accounts separate, or some sort of rules in which you come up with yourself and you abide by those rules. And you need to determine what percentage are you comfortable with. If it's 25% stock and 75% bond because you think that the market conditions are too euphoric, or if you go to 50-50 and you always keep it 50-50 and rebalance at the end of the year, if stocks do well, you sell the stock, and if the bonds do well, you sell the bonds to get to a 50-50. So identify what ratio works for you and then stick to it. And you realize that at certain points the cash equivalent or cash itself or bonds might do much better compared to stocks, but there'll be fewer years. But over the long term, stocks would do much better. Avoid buying the new IPOs or the new listings. Only buy companies which have a long record of profitability and operations. Trading in the market, like day trading, is very hard to make long-term money. Short-term buying, because if you have some insider information, or if you have if you predict some sort of a favorable circumstance for the company because of some sort of a merger acquisition, all of those fall into speculation, and you should avoid buying because those are poor choices, can't be done reliably long term. Also, one other thing to realize is the current price of the stock usually has factored in the current year's results of the company, and also to some extent the future one year growth or something. So if you're betting that this company will do well because this year's growth is going to be awesome, then you'll be surprised because most of the people have thought about this and they've already factored into the price. So going long, at least 1 to 2 years long, is the best proxy. It's not worth picking the stocks to beat the market. There's so many examples in the book which clearly shares that the effort is not worth the cost, and a lot of people fail. And the other way to think about buying stocks is, what if you could buy but you could never sell? What if you could have that rule? Or what if you could buy and never get to see the stock price for 2 years, and the market would close for 2 years and you would know the value of the stock or the price after 2 years? Would you still buy this company? If so, go ahead and buy. Don't take tips from people. It's not reliable. Tomorrow they can stop giving you tips. They may say it works for me. It's like saying there's this city 130 miles away from here. I can drive at 130 miles an hour and I can reach there in an hour, but the speed limit is 65. It worked for someone that they drove 130 miles an hour and didn't get killed. Most likely, if you do that same, you'd either get a ticket from the cop, or you'll be killed in the process. So don't take tips. Do sound analysis. Make sure you buy companies that have strong track record of profit and operations. There are many other tips that people have, and some that people show data around, which is like you buy in December when everyone's selling for tax reasons, and sell it in end of January when a lot of people have started to buy back. Well, everyone knows these tips or these tricks. Once those tricks are well known or publicized, generally everyone's following that, and so you hardly have any opportunity or an edge over the other person. And if someone writes a blog that says, hey, this technique works, long period of time, none of those magical techniques or formulas work, except maybe if they have the three things that Benjamin Graham shared earlier, which is thorough sound principle or a framework that you have developed for analysis of the stock, provide adequate safety to the principal, and adequate return. Those are the three techniques for long-term return, but no magical formula that says buy companies whose letter starts with an A and divided by the stock price square root and figure out the companies which have maximum dividend. All of those don't really work long period of time. So avoid all of those tips, avoid all of those techniques, and all of those blogs that people publish. Also, if you look at large amount of data for a long period of time, by chance, patterns will emerge. So looking at patterns and coming up with your own pattern as to, hey, this is what's going to happen, you will make good, meaningful patterns, but those meaningful patterns usually don't repeat. And those are by chance that those patterns exist. And there's one thing that never suffers a bear market in the Wall Street. It's the dopey ideas. It's those cool ideas. Everyone has those cool ideas, but they never really work. But their market just seems to go up, up, and up. Thanks.